Imagine waking up to a market that's been rocked by fears that some of the biggest names in technology are wildly overpriced, only to see futures hinting at a modest recovery. That's the roller coaster investors faced Thursday night, as stock futures nudged upward following a rough day for U.S. equities driven by concerns over inflated valuations in the AI sector. But here's where it gets controversial. Is this just a temporary blip, or a sign that the tech bubble is finally bursting under its own weight? Stick around, because the details might just change how you view the stock market's future. To help newcomers grasp this, stock futures are essentially bets on what stock prices will do tomorrow. They're traded after the main market closes, giving a sneak peek into the next day's sentiment. On this particular evening, futures linked to the Dow Jones Industrial Average climbed by 95 points, which is roughly a 0.2% increase. Meanwhile, futures for the S&P 500 and the Nasdaq 100 each rose about 0.3%, signaling a slight rebound after hours of losses. The day's downturn was fueled by a sharp decline in key artificial intelligence companies, those trailblazers shaping our digital world. Stocks like Nvidia, Advanced Micro Devices, Tesla, and Microsoft saw substantial drops, dragging down the overall market. Adding fuel to the fire, recent data showed that job cuts in October reached their highest level for that month in over 22 years, marking 2025 as the toughest year for layoffs since the financial crisis in 2009. The tech-focused Nasdaq Composite fell a hefty 1.9%, while the 30-stock Dow Jones Industrial Average dipped by nearly 400 points. Looking at the bigger picture, all three major benchmarks are currently in red for the week, with losses piling up intermittently since Tuesday. That's when major AI stocks tumbled amid worries about sky-high valuations in the tech world, a trend that's made the market highly concentrated around a few dominant players. For the week so far, the S&P 500 has dropped 1.8%, the Dow is down about 1.4%, and the Nasdaq has slumped nearly 2.8%. And this is the part most people miss. In simple terms, market concentration means that if a handful of big tech firms falter, it can ripple out to affect everyone, like a domino effect in an interconnected economy. Yet, not all is doom and gloom for some onlookers. There's optimism that the prolonged U.S. government shutdown could wrap up soon, and a potential interest rate cut from the Federal Reserve in December might ease some pressure. Investors are also keeping a close eye on the Supreme Court's apparent doubts about the legality of President Donald Trump's extensive tariffs, as well as how third-quarter earnings reports from corporations are shaping up. These factors could be pivotal in turning things around. As Louis Navellier, the founder and chief investment officer at Navellier Associates, put it, there's still hope for a year-end rally once the government shutdown ends and the tariff situation is resolved. We're still 2 weeks from the very important Nvidia earnings, and strength there might be the catalyst to reaffirm the AI narrative. If that is followed by a December Fed cut, we may still go out on a high at year's end. He adds that corrections after such big gains are normal and shouldn't cause panic, a reassuring reminder that markets often correct themselves over time, much like how a personal budget needs occasional adjustments. Normally, the Bureau of Labor Statistics would unveil its non-farm payrolls report this Friday, offering insights into job creation or loss. But for the second month running, the government shutdown has forced a delay. Economists polled by Dow Jones were anticipating a drop of 60,000 jobs and a rise in the unemployment rate to 4.5%, highlighting how political gridlocks can directly impact economic data and investor confidence. Shifting gears to some corporate news from the day, Tesla announced that its shareholders have approved CEO Elon Musk's near $1 trillion compensation package, with 75% of voting shares in favor. The vote took place during the company's annual shareholder meeting in Austin, Texas. Additionally, a separate proposal allows Tesla to invest in xAI, Musk's AI venture aimed at rivaling OpenAI, though the results are still inconclusive on that front. This pay deal, which includes 12 stages of stock grants tied to milestones over the next decade, would significantly boost Musk's voting control in the company from about 13% to 25%, granting him over 423 million additional shares. For context, the first batch unlocks if Tesla's market value hits $2 trillion. Right now, it's valued at $1.54 trillion. Musk, already the wealthiest person on Earth, has been pushing for this since early 2024, arguing it's necessary for long-term innovation in electric vehicles and beyond. But here's where it gets controversial. Is this compensation package a fair reward for driving progress, or an outrageous handout that prioritizes one man's wealth over shareholder equity? Tesla's shares ticked up about 0.2% in extended trading and are up 10.4% for the year, showing mixed reactions in the market. In other after-hours action, several companies grabbed headlines. Take-Two Interactive Software's shares plummeted 7% after its subsidiary, Rockstar Games, pushed back the release of the much-anticipated Grand Theft Auto 6 to November 2026 from May 2026. This is the second delay for the game, a reminder of how development hiccups in gaming can send shockwaves through investor expectations. Airbnb's stock jumped about 5% following solid third-quarter results and outlook. The company reported earnings of $2.21 per share on $4.1 billion in revenue, slightly below analysts' expectations of $2.34 per share on $4.08 billion. For the fourth quarter, Airbnb forecasts $2.66 billion to $2.72 billion in revenue, beating the anticipated $2.67 billion, illustrating how strong travel demand can fuel recovery in the short-term rental market. Affirm's shares soared more than 12% after exceeding forecasts on both earnings and revenue. The fintech company posted 23 cents per share and $933 million in revenue for its fiscal first quarter, surpassing the expected 11 cents per share and $883 million. This highlights the growing appeal of buy now, pay later services in a spending-conscious economy. DraftKings, the sports gambling firm, saw its stock drop nearly 4% due to underwhelming third-quarter numbers. It reported a loss of 52 cents per share, worse than the forecasted 42 cents, and revenue of $1.14 billion fell short of the $1.22 billion consensus. This underscores the volatility in entertainment and betting sectors. For a deeper dive into all the movers, check out the full list here. Finally, futures opened higher on the day, capping off a volatile period with a glimmer of optimism. What do you think? Is Elon Musk's pay plan a genius move or a corporate excess? Should we worry more about AI valuation bubbles, or are they inevitable in innovation-driven markets? Share your thoughts in the comments. Do you agree with Navalier's hopeful outlook, or see darker clouds ahead? Let's discuss.